Hi, welcome back everybody. My name is Amy Stakowitz, and I'm a senior auditor at Saltmarsh, Cleveland Gun, and also part of the audit and assurance construction team. Last but not least, I would like to introduce our very own Mike Miller. Mike is a shareholder in the Tax and Accounting Services Department of Saltmarsh. He began his career in 1997 and joined Saltmarsh in 2008. Mike's expertise ranges from strategic planning and financial analysis to tax and accounting services specific to construction contractors. Mike is also a member of several organizations such as the Association of General Contractors, Associated Builders and Contractors, and the Florida Surety Association. Mike is married to his high school sweetheart, and together they have 2 children, a daughter who is a junior at the University of Florida studying engineering, and a son who is a sophomore in high school. In his spare time, you can catch him watching West Virginia football, clay shooting, or even hog hunting. Please welcome Mike Miller. As Egan just said, it's Miller time.
Hey, thank you, Amy.
You're welcome.
Thank you, Michael. Now, I just want to say I want to thank all of our speakers so far. I've learned a lot today. We've it's a really good time to sit and bring some resources and some of the industry leaders out to our clients and our community. And just kind of share what's important to us. You know, we here at Saltmarsh, we love the construction industry. I have been serving the construction industry since 1997. There are times I question my sanity sometimes because, it always seems like, you're so busy and everybody's needs everything yesterday because they got to go did the next big job and need the bond tomorrow. So it's been exciting. But today we're going to talk a little bit about kind of some of the things I see as I've practiced in this industry for over 20 years of what I see the best contractors do. These be like best financial practices. And these best practices, there are no one size fits all. These aren't all one size fits all. These will work for some people. They won't work for others. These are really kind of suggestions, things I've seen over the years, and of some companies that I just really respect and admire, and have had the privilege of serving as their CPA for many years. So, just to kind of go over what does best practices mean for a contractor? Well, it's really pretty simple. To be that best in class contractor, the ones I see the most, they almost always have a plan. They all understand their financial statements better than in me sometimes, and they understand their ratios. They understand what makes their company tick. And when they come across something that is new that turns out to be a better way of doing things, they aren't afraid to implement them. They sit down and make changes, and they're very forward thinking. And I always likened it to if you prepare for something, well, you're going to have success. It's when you don't prepare, as this quote by Ben Franklin, failing to prepare means you're going to prepare to fail. And I truly believe that. And when you sit down and you spend time with the best in class folks, they're really, it's really intriguing. It's really interesting to see what they're thinking and see how they're approaching things. And that very first step is, having a plan. 2020 was a interesting year. Things got started, things were rocking and rolling. Everything looked to be on track to have a record year. The economy was red hot. You couldn't find people to staff jobs. I mean, there was more jobs than there were people. I had clients that were, turning down jobs because we just can't get to it. We just have too much. And then all of a sudden we had a little hiccup there in March with COVID-19. And that just really kind of derailed the year for some folks. And I have clients that, That was COVID was a real big wake up call. They weren't really prepared for it. They didn't really have a plan, and they got into it and kind of figured it out and have developed plans and are going to be better prepared for the future. But that's really what a lot of the best in class contractors will do. They sit down and look at what risks are out there, and they develop a plan. They develop a budget. They set reasonable growth goals. One of the things, we're sitting here just talked about Amendment 2, $15 an hour minimum wage. Whether that makes it this year or not, maybe it doesn't, but it's coming, So, if we got a business, we need to be anticipating that is going to come, whether through just inflation on how the minimum wage is going up now in the state of Florida, which increases 3% a year. It's indexed to inflation, or we go the Amendment 2 route and jump it up to $10 and then $1 a year for 5 years to get it up to $15. Well, that's coming one way or at some point. And so trying to anticipate that and have a plan for that and develop a budget around that, so that when you're out bidding work and you're going to perform in the following year, hey, if you bid something today that's going to have an 18-month build cycle, well, if Amendment 2 passes, you may have your laborers making $11, $12 an hour, and you may have bid it at using $10 an hour. That $1 to $2 an hour increase could be very, very impactful to that project's performance. So what I see a lot of the best-in-class contractors do is they sit down, typically late summer, early fall, and they start thinking about the following year, and they'll set a budget. And the budget's usually, it's not always a real detailed every single line item expense budget, but it's I'm going to budget. I think I need 75 employees next year. I think we're going to need X number of pieces of equipment. I think we're going to perform some extra services. We need to maybe up insurance. We may need to increase our benefits. We may absorb benefit cost. I may be passing out some raises, and they go and they develop that, and they use that to develop their overhead rates that they're going to be bidding on work that they're going to complete in the following year, so that they're not in the middle of a job and realize, man, my overhead's running out higher than what I bid the job at, and so that they anticipate that. The other thing that the best-in-class folks tend to do, is they have a plan for growth, and they sit down and set a reasonable growth goal out there. They're not trying to grow 100% year over year for multiple years in a row. A lot of times I'll tell clients that probably the riskiest thing you can do is grow too fast. You are more likely to suffer a business failure by growing too fast and outpacing your infrastructure and your costs and everything. And you can choke on having too much work. Having not enough work, that's difficult. It's difficult to when you've got to make a certain number, a certain margin to cover overhead and pay yourself as an owner. But having too little work, you can actually manage that. When you try to grow too fast, you can end up making mistakes and hiring the wrong people, putting them in the wrong spots, not able to pay attention to details, and you end up getting into a big heck of a mess, and then realize, you're working much harder than you've ever worked, and you're not making any money. So that's usually what I see with the best-in-class folks. Now, they also sit down and look at their financial ratios and try to anticipate those and try to influence those after they have developed their plan and they've developed their growth goal for the next year. And so they sit down and they say, okay, well, now how are the banks going to view me? How's my accountant going to view me? How's the surety going to view me? And I like to sit down with clients and have some conversations about these things and these ratios I'm going to share. A lot of these ratios are coming out of our review work programs. That these are the things that we're going to calculate when we're doing the reviewed statements, the audited statements, and take a look at. And where we see things out of whack, we want to highlight that to our clients and say, hey, you need to pay attention to this. It's important to understand your liquidity ratios, because a lot of the liquidity ratios are going to generally be the basis for your surety program. Historically, your surety program is going to be some multiple of your working capital. I know there's different companies underwrite different ways. I know there's some that'll underwrite on a net worth basis, but a lot of them, the majority of them, are still going to underwrite off a working capital basis. Well, understanding what working capital is, working capital's, really, your current assets and, less your current liabilities. Well, what's current assets? Well, that's things like cash, receivables, retainage, prepaids, and inventory. Current liabilities, it's your trade payables, your sub payables, your retainage payable, your tax withholdings payable, current portion of long-term debt. And typically you take those two numbers and that gives you your number. And in the old day, or historically, you could typically count on 10 times that as surety capacity. But understanding what's in your working capital and what makes up your current assets, I mean, it's kind of important. We like to see, current assets exceed current liabilities. You would hope that your cash and receivables would be more than your bills. We'd really like to see that as, 130, you'd have 130% of cash and receivables as opposed to your bills, 1.3 times. That's a pretty healthy ratio. You'd like to see that higher, that at that level or higher. The quick ratio is another ratio that you sit down and we take a look at. And the quick ratio, sometimes it's called the acid ratio, is where you look at just what can be quickly converted to cash, which would be cash, obviously, an investment account and accounts receivable. And you look at that versus your bills. And you like to see that even be over 1.1 times to 1 or higher, and that, because that's a calculation of, hey, if things went really bad, can we pay all the bills? And that's what the current ratio and the quick ratios kind of tell you. One of the other ratios I like to look at from a liquidity standpoint is cash to over billings. Over billings are a good thing when they are in the bank. It should be, everyone's goal to, bill, try to bill in advance. I know that's difficult, but to bill that in advance so that your customer is helping finance the job. And that when you do bill in advance, that when it comes in, that you actually retain that money in the checking account so that you can meet the obligations that go along with that billing. A lot of times you can get into trouble when you've got a job that's overbilled and you've been paid, but then you had to burn the cash on something else to fix some other problem. And now you've got to perform the work, you've been paid for the work, and you don't have the cash to complete it. So typically when I see an overbilling on the account on someone's balance sheet, I like to see that corresponding cash at least equal the amount of the overbilling. Okay, that would be a very healthy ratio, And so that's one of the things we like to sit down and see and try to get an understanding of. And because, when you give your financial statements to the bank and the surety, they're going to run some of these calculations and say, okay, is this company trending in the right direction? Are they healthy? Are they liquid? Are they a good risk? Some things to keep in mind in some of this. I sit there and say working capital is current assets, but you need to understand what composes your current assets, because if your current assets are a whole bunch of inventory, a little bit of cash, and a little bit of receivables, well, you're not probably going to get all the working capital credit that you think. Inventory is one of those things that I've seen folks not even get 100% credit on in certain aspects in their surety program. The flip side of that is if your working cap, your current assets is a lot of underbillings, that's going to factor also into the bond program. So sometimes having that understanding of what your current assets are, what makes them up, and doing an analysis periodically and trying to improve that can have a tremendous impact on your surety program. Okay. But that's really liquidity ratios. And, the other set of ratios that we like to look at are some debt ratios, some leverage ratios. And, construction is one of these unique businesses in that, the equipment to do the work is very expensive. Dump trucks are pushing 200 grand new. Excavators can run you well over 300 grand. Motor graders can run you $500,000. Dredges can run millions of dollars. Cranes can run millions of dollars. So those items are necessary to do the work, and it's really hard to pay cash for them, because if you go pay cash for them, you don't have the cash to pay the bills, and it impacts your surety program. And so understanding debt and how to manage debt will help a best-in-class contractor from running into a problem. One of the things, when you get into your heavy equipment guys, everyone understands, the bank understands, hey, you gotta have equipment, you gotta have debt. But, just because they understand that doesn't mean that you should go out and accumulate more and more debt and buy more and more equipment that either is, maybe a little excess or not quite needed, or if you're stripping out all the profits and you're leaving all the debt. I mean, that can make the balance sheet not look as attractive to a lender or a surety. So we like to see a couple things like your debt to equity ratio. We'd like to see that debt not exceed more than 3 times what the equity of the business is. That's a very healthy kind of measure, because in a situation where there was a problem, you go liquidate the equipment fleet, you're probably not getting $100, $1 for every dollar of debt, value. You may be getting cents on the dollar in that transaction, but you'd want some equity to be able to absorb that. The other thing you like to look at is, long-term debt to fixed assets. It's one thing to go out and have $1 million of equipment, but if you got $1 million of equipment and you got $1 million in debt, I mean, that's a sign that, hey, you don't really own any of the equipment, and that you really are just leveraging the bank. And then the question is, well, where's the cash going? Why isn't there some equity in this equipment? And so you got to look at things like that. When you buy a piece of equipment, in today's tax code, you can pretty much take 100% bonus depreciation on it when you buy it. Well, that's saving you, 30+% in taxes. I mean, well, we really probably should, set that money aside, because you're going to have cash outflows on that equipment in years 2 and on, and you've already taken the depreciation benefit. And so you're going to have cash outflow with no offsetting deduction. So it'd be good to keep that cash on hand and maybe get some equity in the equipment. One of the other ratios that we look at is debt service coverage. Can you, in your operating income, service the debt? Or and how much coverage do you have? The goal isn't, if you're making $1 million to go out and have $1 million in note payments. And debt service coverage is basically net income plus depreciation, and you divide that by your annual principal obligations. We'd like to see that be 1.2 to 1. That you're making money in excess of the note payments. That you're not highly contingent upon producing a fixed amount of income to meet your debt obligations. That's a real good sign of a healthy contract. And the good contractors, they will all meet all of these ratios. You may have one that gets a little out of whack, but the debt service coverage is typically one that is not. Debt to equity may get a little out of whack if you have some high dollar equipment like cranes and whatnot. And the other parts of the analysis of understanding your ratios so that you can, better run the business is to look at some of the contract ratios. A lot of times, folks will say, hey, they don't look at their overbillings and underbillings and just say, well, I just bill when I can and bill what I can, and that's what I can do, and I'm underbilled on these jobs because just that's what I can do. One of the key ratios I like to focus in on is overbillings to underbillings, and I like to see that the overbillings match the underbillings, because when underbillings exceed overbillings, and then what that and underbilling is revenue that the contractor has earned but has not billed. Okay, but an underbilling, in my viewpoint, is a loan to the customer. You are advancing the customer money. You're helping them finance their job. And you really should not be in the business of being a bank. Last time I checked, most contractors aren't banks. They can't afford to be banks, and they shouldn't be banks. And they really should focus on trying to keep their underbillings under control. You would like to see your underbillings and overbillings be at a 1-to-1 ratio, where your underbillings exceed your overbillings. That's a net underbilling. That's not viewed very favorably. A lot of times, a lot of folks will start asking questions is like, why are these jobs underbilled? Are these lost jobs that you're trying to hide the loss from? Or are these, underbillings actually legitimate? I mean, could you contractually bill the customer at that point in time? Why didn't you bill the customer? Do you not have good billing practices? A lot of that stems from good controls on the billing practice. And then when you go to the next ratio, underbillings to working capital, a significant piece of your working capital should not be underbillings. Underbillings is that bill hasn't went to the customer yet. They haven't started aging that receivable. Typical contract receivables are going to get, you're going to send a bill to the customer. You may get paid in 30 days. You may get paid in 60 days. Well, if it's sitting in underbilling, well, the customer had that 30-day to 60-day window hasn't started. So if a significant portion of your underbillings is what makes up your working capital, that's not healthy. We'd like to see that less than 0.25 to 1 for underbillings to working capital. That's just a sign of a very healthy contractor. A lot of, you'll hear me talk about underbillings a lot in meetings. They're just, I understand they can occur. I understand some unique contract experiences, contracts that require billing, but the best in class contractors try to find a way to mitigate those underbillings, at least limit them to a manageable level, to where they understand it and they can control it, because it is a risk. It is a loan to the customer. You're having to go out and borrow money off your line of credit or use your reserves to finance that job, and heaven forbid, what happens if they don't pay you? Where's that going to put you? So that's it on underbillings. A couple of the other ratios we like to look at here at Saltmarsh when we're analyzing contractor financial statements. I like to look at net revenues to net worth. That's total revenue divided by your equity. Like to see that 15 times or less. Would not like to see that be a 2 to 1. That's a kind of an inefficient use of your net worth. I mean, that means you have much more net worth than you have sales. I'd have to ask a question, why are you still in business? But you don't want to see that be 30-1 or 20-1, because what we're trying to measure there is your net worth. Try to get a gauge on, do you have enough equity in the business to fund the current contract volume that you're operating in. If you were a $15 million a year contractor with $1 million in equity, you'd be at 15-1. If you're a $12 million contractor with $1 million in equity, 12-1. That would be fairly healthy, because if you sat down and said, okay, well, what's 12 million divided by 12? Well, that's $1 million a month. Well, I have enough equity to cover that that revenue. So I'm not at risk of overstretching the company's ability to meet its current obligations. One of the other, in conjunction with revenues to net worth, we also look at working capital turnover. This is slightly different. This is revenue divided by working capital. This ratio will be a little higher, but again, your working capital is kind of a factor of that controls your bond program. That's what's going to be the basis of most bond programs, and you like to see that being utilized, and you'd like to see that that generate a multiple of earnings. You wouldn't like to see that be a very low ratio, because what that tells you is you've got an inefficient use of capital. If you've got $1 million of working capital and you're doing $2 million in sales, you have way too much capital in the business put at risk for that level of revenue. And you may have reasons for that, but I'd typically sit down and would talk to a client. Is this really a good idea to have all these chips on the table? If you're only going to do $2 million a year, do you really need $2 million in working capital in the business? Maybe it would be a good idea to take some of those chips off the table and go do something else with them, reinvest them in something else. The last ratio I kind of want to go over, one that we is in every single review program that we have here at the firm, is months in backlog. And that's basically your total contract backlog. That's the signed contract value that you have divided by your average monthly revenue. And that'll give you an indicator for how many months of work that you have currently on the books at a normal volume. And you would love to see that be 10, greater than 10. We would prefer that to be greater than 12, that you got a year of work out, a year's worth of work on the books at the end of the year. It's a real healthy indicator. As that ratio goes down, you tend to look at things as maybe you need to make some changes in the business. Maybe you don't need to keep everybody on payroll. Maybe you need to go back to that budget and say, hey, I need to start slashing some things, because I'm going to run out of money at some point in the future because I don't have any work. So that's a very healthy ratio. Now, in all these ratios, I've given everybody where a good target would be, and where possible, where the if you're less than that, whether what the viewpoint on it would be. These are all ratios that we calculate every year with the review. A lot of these I would encourage you contractors to calculate these on a quarterly or semi-annual basis, and just kind of check them, because it'll give you a good indicator of where the business is. Because I get asked so many times, like, well, how am I doing? It's like, well, let's sit down and let's do some financial ratio analysis and say, okay, where are you, and where is my benchmark, and where are you as compared to the benchmark? And this will give you a good understanding, a good kind of feel for where you are in that setting. Okay. Went over some of the financial ratios. Now I'd like to sit down and kind of talk through some best practices. And I've got this broken up into a couple sections, and one of them is basically the fundamentals. The best-in-class contractors, they engage a CPA and an attorney that specialize in the construction industry. That is probably the 1A, and the next item would be 1B of any best practices, to actually have somebody, an advisor that is knowledgeable in the construction industry. Construction law has some unique things in it. There's all kinds of litigation in that industry, and it is very important for every contractor to have a great relationship with their construction law attorney, just so they can, be better prepared in the event that they have a problem. And as society gets more and more litigious, more and more problems are out there, and that attorney partner becomes very important. It's also very important to have a CPA who really knows the construction space. Construction accounting is not the same as regular small business accounting. We've got some different rules. Things are different. The financial statements look a little bit different. When you sit down and talk about WIP schedules with folks and percentage of completion, and then we've got new revenue recognition guidelines that's going to impact. That was a limited delay this year with COVID on implementation of that, but it really cannot stress enough that those two things, attorney and CPAs, basic building block of a best-in-class contractor. They have those. And 1B that's also important is those best-in-class folks partner with an insurance agent that specializes in the construction industry, somebody that understands surety bonds, understands P&C risk of contractors, and can really sit down and give them some risk management advice and some things to think about from a surety perspective. There are a lot of folks that can sell insurance. There are a lot of folks that can sell bonds, but not everybody that can sell insurance and not everybody that can sell bonds. It should be a good candidate to be a partner with. You really want a firm that specializes in the construction industry. We have several insurance agents on this call that all are very knowledgeable in this space. I consider every single one of you guys that are participating today as true experts in the field. And if you're engaged with one of those guys, gals, you truly do have a specialist. But that is building block number 2, because the CPA's got to do the financial statements. They got to look a certain way, industry standard reporting that the surety agent's going to go take out to the underwriting community and try to get somebody to decide to give you some surety credit so that you can then bid on projects, so that you can then build the projects, get paid, earn a profit, and move on. And so these two things are the basic building block, fundamental best practice things you got to have. Third one, it's very important as well, is to bank with a bank that supports the construction industry. There are a lot of banks. There are a lot of good banks, but there are not a lot of good banks that support the construction industry. The construction industry brings some unique risks and unique things that some bankers, don't understand. You've got, contractors use banking services much more than maybe a retail business, because a contractor is going to have should have a line of credit relationship with a bank, probably has some debt relationship with the bank on equipment, and really needs a bank that will understand and support that line of credit, which is key to the business at times, because construction receivables can take 60 days to collect. And so having a line of credit with a bank that understands how to navigate bonded receivables and the construction industry and the peaks and valleys of the revenue cycle, that is not this nice consistent 3% a year every year. You're kind of at the whims of the competitive bid market. But partnering with a bank that supports the construction industry and a banker that understands it's very important too. And one of the last fundamentals is to select a construction accounting software that meets your needs. A lot of folks use QuickBooks. There's nothing wrong with QuickBooks. I have a lot of clients that ask, hey, I want to upgrade from QuickBooks. And I was like, no. You don't have, a construction accounting software is going to give you the information with which to run your business and help you produce the financials, the in-house financials for the bank, the CPA, and the surety, so that they can get timely information. Now, you can go out and spend, $100,000 on the Cadillac package, but if you don't have the staff that can use the Cadillac package, you're just wasting money. So I tell all of our clients, sit down, let's look at what accounting software is going to meet your needs. It's going to meet the needs of the current staff and meet the needs of growth. And let's have a plan for that. We just don't go out and buy the best-in-class software today and then just go tell everybody to figure it out. Because there's a lot of times with the best-in-class software, there's things that you're going to be asked to do that, well, QuickBooks didn't make me do that. Well, you've got to build up into that software and build the accounting procedures and the processes so that you can utilize the software effectively and you can unlock its real value to the firm. So that's something I just tell everybody that, hey, let's get what meets your needs today, and then let's talk about growing up and growing into the needs of the future. So those are the fundamentals. Now we get into best practices for cash and investments. I'll share a couple stories here. You should not have everything in one account at the bank. I've seen clients that you sit down and say, okay, where's your reserve account? Where's your operating account? Where's your payroll account? He's like, well, I just have one bank account. That is That's an extraordinary amount of risk to have everything in one bank account, especially when you're running payroll checks off of it. I have seen some enterprising individuals who received paychecks from a client, copy the numbers off the bottom of the check, copy the check, and go out and order checks online and go home and print checks using the bank information off the operating account, and actually were able to get them negotiated and got paid. And it took a while for that to be found because you had thousands of transactions running through one account, and the poor bookkeeper just was like, well, I just figured we were $500 off on something and moved on. So I cannot stress enough that the best-in-class contractor is going to have their reserves outside of their operating account. They're going to have their payroll outside of their operating account. Their reserves may be a bank that's different than their lending relationship. They're going to sit down and manage their cash that way. They're not going to throw all their eggs in one basket and just hope for the best. The other another thing best-in-class folks do is they have controls on wire transfers in and wire transfers out. That also includes payroll direct debit. In today's cybercrime is growing exponentially. Everyone gets will get the fake email of, hey, open this, download this, do this. These fraudsters are getting so good at mimicking folks that they're can send emails out, and it looks like, hey, the president of the firm is saying, hey, wire money to this person, and folks will do it. You really should have a control on that. There needs to be some controls on that to protect yourselves from doing that. Same with payroll direct debit. I've seen an enterprising individual sit down and the owner's like, man, I approved payroll every week, signed off on it, and I didn't realize my employee was stealing from me. And when we sat down and went through it and helped them out, it was, well, you approved the timesheet, you approved 1,500 man hours on this payroll run, but you actually paid 1,560 man hours on that payroll run. And that extra 60 hours, somebody went in after you approved it and changed the hours on a couple paychecks and paid themselves, and it was out of sight, out of mind. So there should be a control on that. A lot of best-in-class contractors are going to have a cash reserve that can cover a significant amount of payroll. People are like, ask me, well, Michael, what is a good rule of thumb? And I'd say 60 days of payroll. To be honest, if your customer's going to take 60 days to pay you, then you should have 60 days worth of payroll. Payroll is not a bill that you can put off. That payroll bill comes every Friday. And if it doesn't come on Friday, then you don't have a workforce. So you've got to have the cash on hand to be able to meet that obligation. So it's always a good rule of thumb to carry a cash reserve that can cover 60 days of payroll. Now, when you have cash, there's a lot of folks will keep an excess amount of cash in the business. Which is fine. I mean, you need it for bonding purposes. You may have an arrangement with your surety that limits your indemnity and requires you to keep maybe some excess capital in the business. Well, that excess capital shouldn't be sitting in the checking account, not drawing interest. I mean, because that's an inefficient use of that capital. You really should look at maybe investing that in some CDs, mutual fund. Common stocks, things of that nature, so you can get an investment return on that excess capital. So it's not just sitting in the checking account doing nothing. Because if it's sitting in the checking account doing nothing, it's losing 3% because inflation typically runs about 3% a year. So you need to get a return on it of 3% so that you can keep up with inflation. But saying that, you shouldn't just trust your investment advisor to, hey, I'm going to take $500,000 and let's go put it in the market. Go invest it for us. You need to set an investment policy, and you need the financial advisor to adhere to it. I had a client that turned over some money to an investment advisor, and he went out and invested in about 40 publicly traded partnerships, and which are unique investments and really not something that should be a corporation, in my opinion, should be invested in. I sat down with the client and said, man, these appear great on paper until I've got 40 K1s to figure out to add to your tax return. And now your tax return bill is going to be, 3 times what it was last year just because of how you invested your money. I had another enterprising investment broker who thought it was a good idea to get into take one of my clients' portfolios and put it in some derivatives and some straddles and some various really exotic investments because, the guy had a high risk tolerance. He invested in this stuff personally. Well, you shouldn't invest that stuff in the business that way because, that investment income now on your portfolio is now running through the P&L. Okay. It's no longer running through the equity section of the balance sheet. So when we mark to market your investment portfolio, that's hitting the P&L. So, to give you an example, in March, early April, the market was down, 30, 40%. And, if you sit down and you look at if you've got your investment category in some higher risk investments in the business, you probably lost 30% on paper of what the investment value was. Well, that loss of 30% on paper would have hit the P&L, which would hit equity, which would say maybe threw you for a loss for the year to date. Well, that'll scare you, and you need to be mindful of that, of how those investment dollars work and everything. So have an investment policy, make sure that your advisor follows it, keep the investments to short-term CDs, maybe some mutual funds, maybe some stocks. Make sure that they're not high risk, and that way you can have a successful investment portfolio. We'll get into best practices on fixed assets. You need to, the best-in-class folks will have an annual asset purchase budget. They don't, buy equipment with the wind of, hey, I'm going to go buy $4 million of equipment this year and not buy anything for the next 5 years. When you do that, there's a lot of risk involved in that. You end up buying all of 1 year's equipment, and that equipment's all going to age at the same, all age at the same time. It's all going to break down at the same time. It's all going to have to be probably replaced at the same time. And that's just not healthy to go out and, bite off for, several $1 million chunks of purchases every so often. Best in class contractor will sit down and say, okay, if I've got a $5 million equipment fleet, maybe I'm spending $700,000 a year on replacements in that fleet. Just so that A, you can manage the cash outflow for the equipment, B, you can manage the equipment replacement cycle and whatnot. The other thing with equipment is when you depreciate your equipment, you should use a realistic life. I can't tell you how many times we'll pick up a client that is used someone else, and you look at it and you look at the GAAP financials, and all the equipment's fully depreciated, and a $300,000 excavator after 5 years is not worth zero. It still has a fairly significant value, and you should not be depreciating that over a 5-year life. You should be sitting down, establishing what a realistic life is, and then also establishing a salvage value for that equipment at the back end, because it's still got value when you're done with it and you're going to replace it, even just scrap value. And you shouldn't be charging all of that off to earnings through depreciation. You should be capturing some of that value so that, it'll lessen depreciation expense to the P&L, which will increase income that'll go to equity, and it will just make the balance sheet look much better. When you have equipment, you should track what kind of return the equipment's giving to you. I mean, is it worth buying the equipment as opposed to renting? Well, a lot of folks don't know. You should set up an internal equipment rental rate and charge it to jobs and measure the effective internal rental income versus the equipment repair costs, and see if it's actually worthwhile to own the equipment as opposed to leasing it from United or any of these other equipment rental folks. You really should track equipment repairs and equipment downtime. Equipment downtime is probably one of the single biggest hidden costs for a heavy equipment contractor. When a machine breaks on a job, oftentimes that crew may or may not be very forthcoming in, hey, the machine broke down at 8 a.m. You may not get that phone call till 1 p.m., especially if there's no project management team there. So tracking that so you can capture those costs and make decisions on whether or not to retain the equipment or whether it's even worthwhile to own it. Lastly, I put a bullet point on consider GPS tracking of corporate-owned vehicles. Construction industry, it's very common for construction staff to get vehicles as kind of a perk for employment. That's okay. I just would strongly encourage you to put some kind of tracking mechanism on it. You don't want to find out that your truck that you're paying for, that your employee took to the hunting camp and went and hit a tree with it and caused $10,000 worth of damage that you now have to fix because you own the truck and you file a claim on your insurance for something that he did that you have no way to prove that, hey, that was done on his dime. So you really should have some kind of tracking on that. It's just a good control. We'll talk about debt. Every contractor should have a line of credit. If you do not have a line of credit, you need to call your bank and get a line of credit. That line of credit, you need to ask for as large a line of credit as they'll give you. Worst they can say is say no. 60 days of costs, that could be a very significant line of credit. That's just a general rule of thumb depending upon size. If you're a $100 million contractor, that's not going to be enough. We're not going to go get 60 days of cost. But if you're a $5 million contractor, we might go tell you to go get 60 days of cost. If you're in a heavy equipment business, go ahead and ask your bank about an equipment guidance line. That's basically a line of credit for you to buy equipment. So you're pre-approved, so you don't have to go through the hassle of submitting documents every time you want to buy a piece of equipment. You're already approved. You know how much you're approved for, and that will go along well with your annual asset purchase budget. And you coordinate those two things. And so when you need equipment, you can buy it and your finance, and it's very easy. And I like those. And when you compare that to 0% financing offers, A lot of times 0% financing offers are not really a true 0%. You are actually paying more for the equipment than if you'd paid cash. You need to do the analysis there. And that's why having the equipment guidance line, you can maybe pay cash and capture some value there. When you buy equipment, please finance it over a reasonable period of time. 48 months tends to be a fairly reasonable period of time. 60 is also reasonable. 36 months, 24 months, you're impacting your working capital heavy because you're going to the 12 months of debt payments that are going to be included in current liabilities is going to increase dramatically. That's going to impact your working capital, impact your bond program. Paying cash for equipment will do those things too. So when you're financing equipment, do it over a reasonable period of time. You need to periodically review your interest rates on all your existing debt. Make sure that you don't have a refinance, payoff, or trade-in opportunity. And when you pay something off, you should maybe consider saving that monthly payment, setting it aside, continue to set it aside because you're going to have to replace that piece of equipment anyway at some point. So why don't you just start saving for it? You've already committed to it. You've already committed to monthly payment. Why not just transfer that to the savings account? So when we get into contracts, I'm going to hit a couple here. You review bid spreads when you get them. Just see how far out of line you are. You don't want to be too out of line. You don't want to find out you were the low bidder and you were the low bidder. You were the only low bidder, and everyone else was above you by $1 million. Then question, what did you miss? Big thing to do is review net contract to under billings with your project team. That's net of over billings. If you're net under billed, the project team, you need to ask why we aren't billing. What's happening, get in front of that. Is the project team, do they have a lost job that they're not telling you about? That tends to be what that tends to be what the reason for that is. Contractors, you need to set up a meeting with the project team, the accounting department, management, get together on a recurring basis, sit down, talk about jobs, cost to complete, billing schedule, cash flow needs, fade on particular phases, just to get a handle on the jobs. Because if you're doing that while the job is in progress, you can course correct and maybe lessen the damage of a bad job. You really need to look at that. You don't want to get to the end of the job and realize, man, I lost money on that job. What could I have done differently? Because you can't do anything differently at that point in time. One of the other things is when you do have a lost job, recognize it as early as you can. Sit down and say, okay, I got a lost job. Don't try to sugarcoat it. Sit down and say, okay, estimate the loss. I say throw the book at it, but estimate the loss as reasonable as possible, but be conservative. You don't want to say, well, I've got a lost job, I'm going to lose $100,000 when there's a chance you may lose $500,000. Why don't you just book the loss for what, do the best estimate you can, but try to be as realistic as you can with that loss. It's better to take the lick once than to have it that linger over 1 or 2 years. Okay. Another thing is accrue your estimated warranty costs. Don't hold jobs open for warranty costs, because all you do by holding the job open for warranty costs is give somebody a bucket to maybe charge some time to, that you may or may not realize that they're charging costs to the wrong job because the job's being held open to capture the warranty exposure. You'd get a lot more visibility if they were charging, if it's a warranty issue, to charge it to the warranty accrual account, so then you can go look at it. Well, what am I spending on warranty? It's not getting sucked up into contract costs in the WIP schedule where you kind of lose sight of it, because that tends to be a profit leak. Some more best practices. Consider cost escalation language where you can get it. I know that's tough. Not everybody's going to sign that contract, but this last year, lumber prices. We just heard average home price was up $16,000 for lumber cost. Try to get that language in your contracts where possible. Look at your contract billing schedule, try to structure it in a way that it will improve the cash flow. If you got a lot of high cost, low margin items at the front end of the schedule, you may want to do some shuffling of the values on the schedule of values to try to, get some more margin on some of those low margin items up front. We heard earlier today about underwriting your subcontractors. I can't stress that enough. I could tell you story after story after story where I've had clients hire a sub that because they were the lowest price, they didn't really underwrite them. They said, hey, it was dirt cheap. I took the job because, man, I'm getting a deal. Well, you remember, you get what you pay for. If you don't underwrite your subs and they fail on you, it's probably going to cost you a lot more than if you hired a first-class sub to begin with. Also, you should consider bonding your critical path subs and suppliers. You don't bond the painting guy, interior painting guy. You may not bond the landscape guy, but you really probably should bond the site guy, the structural steel person, the concrete contractor, and the big ticket material supplies. Make sure that in this COVID arena that you don't get hit with a disruption that can cause you significant delays on the job that you cannot be compensated for. Kevin and Brett mentioned earlier, talking about making sure that check your funding sources. That's so important to sit down and know who your actual customer is as the contractor and what is their ability to pay. This goes for the subcontractors working under a general for a developer. I mean, I would want to know that the developer I'm working for can pay me. I would want to know the general I'm working for can pay me, especially if I'm sitting there as a sub holding a bond. I would want to know that, hey, who is the ultimate customer, and can they ultimately pay me? If you're looking at, there's a lot of mixed use buildings and things going on, condos. Condos have been kind of hot and cold. But if you're going to build a condo, maybe you should think about putting in a special purpose entity. I can't tell you how many times that I've sat down with a client who's done a condo, and then just as soon as they start selling the units and it's close to completion, then the lawsuits start coming. And then you start spending a whole bunch of money on lawyers trying to defend yourself. Maybe we should separate that out from the main entity and put that in a special purpose entity to do that one project, just to limit risk. Anyway, I got a couple more best practices. Owners, pay yourselves a reasonable salary. Don't pay yourselves, 20 grand a year, then everything else is a distribution because you're using the corporate credit card to pay your personal expenses. When you do that, you cause a lot of risk in the business. One, are you really separate from the business? You really should put yourself on a reasonable salary. Use your own credit card for your own personal expenses, because I had a client where him and his whole family used the credit card to pay all of their personal expenses and everything. And the controller thought it was such a great idea. She decided to get her own credit card on the company account and do the same thing and participate in the spending. And $150,000 later, we realized that probably wasn't a good idea. So separate as much as you can the owner's personal checkbook from the corporate checkbook. Okay. Pay yourself a reasonable salary. Take a reasonable distribution. Don't just treat the corporate checkbook as just your own personal checkbook. Don't have your kids driving a whole bunch of company vehicles. Get all that stuff off the corporate books. There's a lot of risk involved there. You don't need to have that risk. Have those on your personal financials. Get them off the corporate books. When we get into construction, best in class folks will sit down and look at continuity. You need to have a continuity plan. The best in class contractors have one. They also have employment agreements with their key employees, because if something were to happen to the owner, they need those key employees to step up and finish the projects and help transition the company to, in whatever the plan is. Also, when you have key employees, you might consider getting some life insurance on those key employees so that Hey, they may have there's if something happens to them, it's very difficult to replace them. The company would have the capital to maybe go out and hire the headhunter to find an adequate replacement to replace that key employee. Really the best in class folks, they have this continuity thing down pat. I mean, they have plans, they have their key people identified, their key people know what their roles are, and they have everything in place to take advantage of there. And last, last but not least, we're going to talk income taxes. Don't let income tax drive the bus. There's every tax deduction that's out there, for the most part, costs cash at some point, whether it's a cash today or cash over a period of time. There are very few that do not require the expenditure of cash. Every dollar you spend is only saving you 37 cents at the top tax bracket. So that means you spent 63 cents. Look at that, pay attention to that. There are other ways to help with taxes. Contractors have over 6 accounting methods they can use on their tax return to create some tax deferrals for revenue recognition. You should utilize that. We've been in a period of low rates. You should take advantage of those low rates now. You can make $620K today, up to $620K today, and before a qualified business income deduction, you're still at less than 27% tax rate. That's one of the lowest it's been in a long time. But don't run your company to the thought of, I'm not going to pay any tax. There's things that can be done, and you can use those tools, but just don't spend money just to not to pay tax, because you're going to impact the business, impact the profitability of the company, bondability, and all of that. And with that, I know I kind of rushed through a lot. I could speak on this topic for all day, actually. But with that, I'll open up the floor for questions.